Explain the difference between stock and asset sales. A stock sale involves the acquirer purchasing the target stock from the company's shareholders for some form of consideration. It assumes all assets and liabilities of the target company, and the target company does not exist post-transaction. An asset sale refers to an M&A transaction whereby an acquirer purchases all or some of the target's assets. Under this structure, the target legally remains in existence post-transaction, which means that the buyer purchases specified assets and assumes certain liabilities, but not all of them. Now, a potential follow-up question is, how are the two transactions taxed differently? With a stock sale, post-transaction, the target does not exist anymore, as it becomes part of the acquirer's company. So from a shareholder's perspective, a capital gain is triggered if the target's shares appreciate in value. They are taxed at the shareholder's marginal taxed rate, and they are taxed once. So when the company is sold, if you are the target's shareholder, the assets, the shares jump in value, and then, post-transaction, the shares don't trade anymore on the market, so you get that cash or that form of consideration. So a capital gain is triggered for that appreciation in the stock. For an asset sale, the target exists post-transaction, and if the company wants to distribute these proceeds from the asset sale, a double taxation event occurs. First, when the company sells these assets at a profit, a capital gains tax is paid at the corporate level for the difference between its book value and market value. Now, the entity receives those proceeds, right? And so they get taxed at their own corporate level. Now, secondly, when the proceeds are distributed, the appreciation in the company's stock triggers a capital gains tax for the shareholders at their marginal tax rate. So it's a double taxation event. The company pays tax on the gain of the assets, and when they pay out maybe a dividend or they just sell the remaining company, the shareholders get taxed again at their marginal tax rate. So another follow-up question is, in what scenario would each transaction work best? The double taxation event mentioned in the previous question is why asset sales are less common than stock sales, especially for corporations. But there are certain scenarios that work better for each type of sale. For a stock sale, the most common, any acquisition of a profitable company would be an ideal transaction. It ensures that shareholders are taxed only once and the buyer is responsible for no further liabilities. Now, for an asset sale, a common example is a target who is currently reporting operating losses and would like to offload one of its non-core businesses to offset the capital losses for the holding company. The buyer acquires the assets, the seller uses the capital gain to offset losses in other divisions, and no double taxation event occurs. So for a conglomerate, maybe selling a non-core business and is reporting, because of a recession or a downturn in the economy, is reporting losses in its overall operations, it can use that sale of the non-core business to offset the losses and therefore pay no corporate tax, even though maybe shares appreciate in value and the shareholders, if they wanted to sell those shares, would be taxed at their marginal rate.